You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
Welcome. You are listening to and watching the Financial Survival Network. I'm your host, Kerry Lutz. Well, we had this person on a couple of months back, written a book that I really believe, needs to be paid more attention to. The name, it's an Amazon bestseller. It's called Outgrowing Capitalism, Rethinking Money to Reshape Society and Pursue Purpose. The author is Marco Dondi, and you are with us now, Marco. So book's been out for about a year and things haven't gotten much better. I don't know how much of the advice that you've provided in the book has been followed, but just to bring us up to date, what is the premise of the book again, and how could it help things right now that are going on in the world?
I would say premise of the book, especially linked to what's happening today, is that we have as a society much more power to direct money creation in a way that it better meet the needs of each of the countries that is controlling their own money creation. Then letting the financial system generate money through the typical market mechanism of banks granting loans to individuals and companies that ask for them, which as I remind that it mostly goes to real estate, and it's one of the causes of inflation of asset prices, especially houses. I would say, so what's happening today, I would say to some extent, some significant changes have happened. If you think even, already during the pandemic and even now, we are still, from a public policy perspective, spending a lot with the underlying assumption that the central banks are not letting the governments ultimately go bankrupt, right? If they need to buy their government debts, they will. I think this has had different implications, but at a time of massive investment for war, massive investment in the US for the Inflation Reduction Act, which is still actually a lot of public investments and subsidies. It seems that the governments, at least on the government side, they have taken the view, some may argue a bit too much, that indeed we are not as constrained when it's about money. We are constrained when it's about resources. I think now we have hit the resource constraints because energy prices are raising, inflation is rising. So I think compared to when I wrote the book, now we have hit the ceiling probably on how much we can push this money creation. And therefore we are in the discussions of, okay, but then if we have pushed too much, how do we then pull back? And so I think the most interesting discussion is actually this, right? In the US, in the UK, in Europe, given now you push too much, possibly not exactly in the way that I mentioned in the book, but you anyway, somehow we have put a lot of money in the system. And I think there's agreement that now we are really, at the edge of what the economy can sustain. I think part of inflation is just linked to energy and supply chain disruption. Part of inflation is clearly linked to the economy being overheated, right? So how to best pull back? And I think, here is where I am not seeing much difference compared to the old recipe, right? Central banks are still increasing interest rates. This is the only tool they had. This is what I mentioned in the book, right? They are doing what they can with the only tool that society has given them. I am somewhat surprised that they have done less of the removing money from the economy, which, with quantitative easing, you put money in the economy by buy assets. They could just sell those assets. And by selling those assets back into the market, they would take money away. I'm surprised they're doing little of it, which I assume is because they don't actually really know what they could cause if they start really selling assets, what they could cause to the prices of those assets. And so therefore they prefer to increase interest rates with all the potential negative implications that this may have. At the same time, also this is proving that this is taking quite some time to have impact, right? Like I mentioned in the book, but many argue that interest rates themselves are just completely ineffective because in reality, in the short term, they're actually paying more money to the private sector because, those interest rates are paid and they're paid by the central bank to the private sector. And therefore, they're injecting even more money to society. The real counter effect is where banks start not giving loans or people and companies start defaulting. And that will, of course, reduce the money supply because banks will create less money, but that will also cause an economic crash, right? So I would say on balance, I think the policymakers had started even before I published the book with due to COVID and even before due to the financial crisis to say, okay, we can actually inject much more money in society. And we have seen that this so far has not caused inflation. Now, last year, given the war and supply chain disruption, this did cause inflation. I think I've seen very little change in how monetary policies is conducted. And I think, unfortunately, this will lead to, either not really bringing down inflation or causing a recession, which is not what we really want. And this, unfortunately, is, the only evidence of the effectiveness of central banks in cooling down the economy is their ability to cause a recession. And when they cause a recession, then inflation also comes down, right? But, you're not cooling down inflation without causing a recession, which, I think the cooling down of inflation we're seeing is just because, energy prices are going back down, right? It's not because there's any less credit growth or because the interest rates really had an impact.
Okay, so there is a limit to what they can do here. Like you said, they're skirting between two extremes. One is runaway inflation, and the other is really crashing the economy. And they aren't really, if you look back in the history of central banks, especially the Federal Reserve, they haven't really been very effective stewards of the money supply. And we have the business cycle, the boom bust, and we have bubbles. And those are the direct result of central bank policies, aren't they?
I would say more, some of this is direct, some of this is indirect, right? I think the growth of the credit, I think until the financial crisis of 2009, that's mostly been driven by the private banking system, right? I think then the big push has been from central bank, indeed, from the financial crisis, and even more so after COVID. I think where there is definitely a direct impact is when they increase interest rates so much. I mean, you can argue still indirect because it's still people and companies defaulting and banks keep giving loan. But the reality is that it's they know, right? Everyone knows that by increasing interest rates, you are actually making debt repayment much more complex. And so you are playing a bit with the sustainability of the financial system and see how much you can, trying to poke a balloon without making it explode, right? Which is not really easy, if you know what I mean.
I like the analogy. I do like the analogy a lot there, Marco. I think that's an accurate analogy. And I think that others have called it, pulling on a string, pushing a string. You could come up with a lot of analogies, but until they figure it out, what's going to change here? What's going to happen?
It's a good question, right? I think to some extent now it's tricky. In the US, you actually still have inflation that is higher than the interest rates, right? So if you are, the stereotypical rational investor, you're still not incentivized to reduce your lending, like your borrowing, and from a bank's perspective, your lending, right? Like you borrow today at interest rates that are lower than the inflation, and therefore you still keep going, right? So this is not really effective.
Great time to be better, right? Borrower, it's really a great time because your after inflation cost is negative, and if you can get any kind of cash flow off of the money that you're borrowing, any kind of cash flow above the interest rate, you're still coming out ahead, even though you're below the inflation rate. So this encourages hyper leveraging, doesn't it?
Don't just survive, thrive. The Financial Survival Network.
Fury Gold Mines is a Canada-focused exploration and development company committed to aggressively growing its scalable, high-grade gold assets with major drill campaigns planned across its 3.5 million-ounce portfolio. Fury is led by a management team of proven explorers and developers with a track record of success in advancing and financing project development. Fury Gold Mines is well-positioned to create value for investors with low-risk development growth and the potential for a new major discovery. Fury Gold Mines trades on the TSX and NYSE American under the ticker FURY. To learn more, go to furygoldmines.com. That's furygoldmines.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
Yeah. So you're basically still in a situation where you're not cooling down leveraging, but you're still actually making it more difficult for some debtor to repay. Those that have the interest rate are somewhat linked and variable depending on the interest rate. You're still increasing to some extent the cost that the government needs to repay on their public debt. Again, the one that is short term that is immediately impacted by the interest rates, and therefore, on balance, it's. I don't want to be too negative and pessimistic, but you're kind of in the worst of all possible situation, right? Because you can't really, you haven't felt like pushing the interest rate all the way to really bring in the real interest rate, inflation adjusted in negative territory, where you start saying, okay, now is not the time to borrow. So the speculators and the heavy leverages are still there. On the other hand, you have caused some complexity to those that need to repay. You are putting more burden to the government, which ultimately at some point, when the deficit looks too high, there's always some pressure to cut spending and increase taxes. So it's a bit of the worst of the two worlds. On the positive side, though, the economy seems to still be doing pretty well, right? So I guess that's the part where the positive note is functioning. In the US more than, I guess, in the UK and in some European countries, but also in the European Union to some extent, there is resilience and there is more optimism now than there was last year. So I guess that's the positive news.
Yeah, but how long can it go on? That's always, any rational person is going to wonder, this thing is really being... it's really destructive. How much longer can this thing happen? Can it keep going on at its current rate? Does it not matter how much money they print up? Is it irrelevant? I just don't get it.
So look, I think the way I read the fact that both in the financial crisis and in COVID, there was so much money printing. We're talking large scale, right? For COVID, there was about 10 trillions over a period of a year. That is it's really unprecedented. And the fact that, until we had these supply chain constraints and until there was this energy issue, inflation actually didn't budge much. And we were still not reaching full employment, maybe with the exception of the US. But arguably, some may argue, even in the US, you still had underemployment and a lot of people that you can bring back. So that one to me was a sign of definitely we could push more. And my reading of this is, it's not about the amount of money in society ultimately, right? It's how much of it is being spent. And, in the book, I wrote a lot about the fact that inequality drives, even if you have a lot of money in the system, but inequality leads to have many of these among few people that are wealthy, they are investing, they're speculating. Those things circulate a lot in the asset markets, and, they make the stock market go up, they make the bond market go up, any assets go up. But from a productive economy perspective, you actually don't have as much spending in the middle class and in the lower class and in even the affluent class, right? Because that money is not circulating in that area of the economy. It is basically just circulating in the financial markets. And so in that sense, I think some of the money that has been injected actually has gone to the middle and to the poor and to the poorest in the society. And so that has actually stimulated quite some economic growth. And so I think that was all positive. But I guess the question is still now, ultimately, the capitalism machine is still there, right? All of this money are injected. They may be injected in one side of the economy to some players, but ultimately it all kind of triples up. and it gets accumulated, and it gets, you go back to the speculation and the inflation of asset prices. And I think this is where we are, right? Like it's to me that now there's clearly so much more money in the market that it's depending on where that moves, and the movements of this massive amount of money will cause, of course, significantly disruption and significant movement in the real economy and in the financial markets, right? So I think from a risk perspective, and it's still super high. We'll see what central banks manage to do. I mean, it's really dancing now.
Yeah. So Marco, when we talk in a year from now, what is the world going to look like in your opinion?
Now you're asking the crystal ball.
Yeah, look at your crystal ball. Nobody's holding you to it.
Look, I think a lot today, really a lot depend on this energy market situation. I think there has been signs of more resilience, and therefore, for this reason, I'm actually inadequate to answer your question, right? Because the biggest element of the crystal ball is the energy market, and I don't know it that well, right? Like I think I've noticed resilience. Like Europe, everyone was panicking some time ago, rationing energy, closing down factories. For a variety of reasons, this hasn't happened, and now people see it as, we're going to wean off Russian oil and gas, and probably we'll just find alternatives. And yes, maybe we pay a little bit more, but this is not going to really change the economy, right? At the global scale, there's still a significant shortage of energy, right? Besides, like I was seeing an analysis that, the energy shortage didn't start with the war. It was already ongoing. The war just made it worse.
Correct.
And therefore, how much the whole world is going to invest to make up for the gap of energy, I don't know. I think that's probably the biggest question from an economic standpoint. Do I foresee the risk of an immediate financial crash? I think if there is one, I feel it's probably more linked to this significant amount of money that may move in different places. And so that at some point you can still have some market panic where, you see massive sell-off that, compound on each other. But otherwise, I think the interests are still in relatively low territory. The labor market is still very tight and very strong. Maybe it's more really a question of, most of the discussion these days, let's see if it's the same in 6 months, but I can't find people. I can't find people to hire on a variety of, low skill, middle skill, high skill, like across the board, there is a shortage. And it's a very uncertain and difficult picture to paint. So I think on the crystal ball, I would really not know what is going to be in 1 year time.
That's fair, because nobody knows what the future will tell. What's in store, let's face it, who the heck knows? But hey, we appreciate your coming on. Just tell us where we find you, where we can get more info and purchase the book.
Yeah, so there's still a website that is outgrowingcapitalism.com. Book is on Amazon. I think probably that's the easiest, but it's in a variety of other online stores if you prefer those. There should be in some airports in the US, I think in a few of the Hudson across different US states. I think people that read it has thoroughly enjoyed it, sometimes find it something that you need to think in some areas, which is fair. I think some of the sections are to be switched on. Some are more relaxed and easy reading, but everyone has enjoyed the thought-provoking questions and sometimes proposals.
All right. Well, we really appreciate you coming on. If you've got a question for Marco, a comment on the book, or anything else that we do here at FSN, just shoot us an email, and it's kl@kerrylutz.com. Make sure you go to the site. You'll see a link to Marco's book there, financialsurvivalnetwork.com. Click it. You can buy it today. And while you're there, sign up for our free newsletter. Marco, always a pleasure. Thanks so much for coming back.
Thanks, Kerry, for having me back.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now. more than ever.